Okay, we've done 4 cases already. Right now, a special thing about convertibles 转换权 is induced conversion 诱导转换. You know, who decides to convert or not? Creditors, right? But sometimes your company maybe want creditors to convert the bonds. How? You have to give them some incentive. So maybe you will give creditors some incentive to ask creditors convert to shareholders. Okay. So here talk about induced conversion means you want to encourage creditors become your shareholders. Because of that, you have to give them some incentives. Okay, so this is the part we want to talk about. Okay, encourage creditor become shareholders. So you give them some incentives. Some incentives means what? You have to give them some additional money or additional shares, so on. So all of these kind of things, incentives, we call it sweeteners, sweetener, 甜头. Okay, so for this part, sweetener, you give them some additional money or additional shares. We recall it as expense. Why? Because there's only one time shop, right? Only one time shop accounting, we recall it as expense. So this is the only thing we want to talk about. You give them some incentive to convert CB bonds into shares. So for this additional incentive, we recall as expense. Okay? Then how much? Of course, market value, fair value, the amount you give it to them right now today. Then why your company want to do that? Why your company want to make creditors become shareholders? Of course, because you don't want creditors, right? So why you don't want creditors? Because you don't want to pay interest. So the first reason your company want to do that is you don't want to pay interest. That's why you ask creditor become shareholders, then you don't need to pay the interest. Also, your liability will be decreased, right? Maybe you want to reduce your debt to equity ratios. You don't want to have too much liabilities on your company's financial structures. You don't want to have too much liabilities. Why? Sometimes when liability too high means what? When your company's liability too high means what? Too high means what? Your company's risk is too high, right? Liability too high means risk is too high. Why? Too much liabilities. What if someday your company don't have enough money to pay the liability? Then your company have financial crisis, right? So usually liability too high means your company's risk is too high. Okay? So when your risk is too high means what? No one wants to lend you money, right? Because you have a too high liabilities. It's easier to find someone lend you more money. Impossible, right? So it's difficult to borrow money. Or even though you really can borrow money from the bank, you should pay higher interest, right? So even though you can borrow money from creditors, then you had to pay higher interest. So you will have higher interest rate. So higher interest rate. Okay. So when you find out your liability is too high, no, liability is good for your company, but always everything too high, too low is not good. So someday, if you find out your liability is too high, so you try to reduce the liability, okay? Because of that, maybe you want to convince creditor become shareholders. Then how? Give them some incentive, okay? So for this case, on your slide 90, or you can look at your note on page 23. Your note on page 23. So what happened on your note page 23? You have the CB, convertible bond, okay? So for this CB, you could convert it into 100,000 shares, par value $1, okay? And for this one, your share premium conversion equity, this amount. So what does it mean? This is your convertible book value. Your convertible book value. Okay. Then your company wishes to reduce interest cost because of these reasons. You decide to give them creditors additional $80,000 if they will convert. Okay, so this is the sweetener you give to creditors. Incentive of conversion. Okay, and also today the book value of your bond is $1 million. So we give it the information. So this is your bond's book value today. Today means what? Means you give the incentive to creditors. Okay? So based on this, you give them $80,000 cash to encourage creditors become shareholders. So in this case, two things, right? What are these two things? First thing, you give the sweetener to creditors. Second thing, creditors convert into shareholders. So conversion. Creditors convert into shareholders. Remember, they become shareholders. Which method we use? They change their identity. So which method we use? Book value method, right? Okay. So based on this, do you know how to answer the journal entry on your page 23? So on your page 23, you had to record two things, right? First is you give the sweetener to creditors. Second thing, they convert to shareholders. Okay? So based on this, first thing is what? You pay the cash, $80,000. We recall it as expense. This expense we call it conversion expense, 转换费用. How about second things? Second thing, creditor become shareholders, right? So please use book value method to transfer creditor become shareholders. So could you finish by yourself? The book value right now is convertible book value, $15,000. Bonds book value is $1 million. Convert into shares. How many shares? 100,000 shares. Par value $1. Okay. So for first one, this is your sweetener. Second thing is conversion. Creditor becomes shareholder. So from book value, transfer to shares. Share capital is how many shares? 100,000 shares times $1 par value. Okay, no problem. If you don't have any questions, if you understand CB, then we talk about still convertibles, but convertible combined with not bonds, combined with preference shares. Okay, so same logic, same concept, but easier one for preference shares. Okay, so we talk about on your slide 93, still convertibles, but with preference shares 特别股 combined with the preference shares 特别股 So means what? You give preference shareholders the right, the options to become the boss, ordinary shares, right? Okay, because you should understand preference shareholders is not the boss. They are not the boss. They only can get dividends each period. Okay, so preference shareholders actually more like their characteristic, more like creditors. Okay, they can get the fixed amount of money. Creditors can give, can receive fixed amount of money interest. Preference shareholders can get, receive fixed amount of money dividends. That's it. Okay, so you give them the right to become the true boss, owners, ordinary shareholders. Okay, so totally actually the same as the bond. But one thing a little bit different is when we talk about the CB, CB is what? Bonds plus convertibles, liability plus equity, right? But here, preference shareholders we put it into where? Equities. So this one is a little bit different, is equity plus equity. Okay? So your preference shares, actually, preference shares is equity plus equity. Okay, so this is a little bit different from CB. Is equity plus equity. So only one nature, only one characteristic is equity. Okay, it's not like a CB. CB is liability plus equity. Okay, so if you understand in accounting, when we talk about preference shares plus equity, equity plus equity, only equity. So in accounting, you understand it's more easier. Why? Because they are on the same section. Since they are on the same section, do we need to separate into two parts? We don't need to. Okay. So for CB we need with and without method. Why? Because CB we have a liability, we have equity. They are totally different. So we have to separate into two parts and report them into two sections, right? But for this one, we don't need to because they are only equity. Okay? So we don't need we don't need with and without method for convertible preference shares. We don't need. Okay. So when we talk about the CB is compound instruments. Compound instrument means what? 复合工具 means what? They have liability equity at the same time, which is compound instrument. Okay, so since they have liability equity at the same time, that's why accounting we need with and without method, trying to figure out how much for debt, how much for equity. But for convertible preference shares, they have only equity, right? Equity plus equity is equity. So it's easier for accounting. We don't need with and without method. We don't need to separate that. We just put it into one amount. Okay? Any questions? No problem. Okay. So first thing for convertible preference share, first thing different from CB is we don't need with and without method because they have only equity. So first thing is we don't need with and without method. Second thing is different is what? When we talk about CB, when we talk about convertible preference shares, is convertible preference shares 特别股. Do we have the maturity date? We don't have. So that's why shares without maturity date. So that's why they only have a two case: conversion or give up the right. Conversion, shareholders, preference shareholders become ordinary shareholders. Repurchase, they give up the right. So we have only two cases. But no matter which case it is, when we talk about equities, second difference is no matter which case, we don't have the gain or loss, right? Equity, we don't use gain or loss, right? So second different from CB is no gain or loss. No gain or loss. Let you guess. If conversion, why no gain or loss? Change your identity. Which method we use? Book value method, right? Book value method, will we have a gain or loss? No, book value method, we use the same amount, change the identity. So book value method, no matter we talk about CB, no matter we talk about convertible preference shares, change the identity. So the accounts change, the amounts the same. So will we have a gain or loss? Of course not, because we use the same amount. So when we talk about conversions, book value amount, of course, no gain or loss. Okay? So when we talk about conversions, we use book value amount, 账面金额法. So of course, no gain or no loss. So why is no gain or no loss? Because same amount. So we use the same amount of book value. So that's why no gain, no loss. Okay? How about repurchase? Repurchase, of course, you will pay higher or lower money, right? When we pay higher or lower money, you will have a gain or loss. But remember, when we talk about equity, we don't use gain or loss. So when we talk about repurchase, of course, you will pay higher or less money. More or less. But the difference BV with NV, remember the difference, we don't use gain or loss. We use what? Is share premium. Okay, so still, no matter what kind of reasons, for equity, we don't have gain or loss. Okay, If you understand these two major difference, then it's easier for you to answer this part, convertible preference shares. Okay, so let's look at the case, two cases only, right? For preference shares. First is conversion. Second is repurchase. So let's look at your slide 98. 98. This is for what? The issue date. Okay. So today your company decide to issue 1,000 not CB, convertible preference shares. Convertible preference shares. Okay. So for this, par value $1, selling price $200. So par value $1, selling price $200. Then how we recognize it? Because all of them are equities. Since they are equities, we don't need to use with and without method. We just put them all together. Okay. So how to the same as how we recognize issuing the shares for ordinary shares, for preference shares. When we issue this kind of shares, how we record it, we use the same way. Okay. So selling price, how much? $200,000 for 1,000 shares. Share capital for par value. The others we put it into share premium. But here we use dash conversion equity to tell them this shares is convertible preference shares. Okay, so did you find out totally the same as before, but we use dash convertible conversion equity to tell them this convertible. Okay, you can write down it on your note, page 25. Page 25. So did you find out it's quite simple, easier, because all of them are equities. So we don't need to separate them into two parts. We just put it together. Okay. If you want to use the same as before, is okay. The same as before dash preference. But we don't prefer this one because it's quite hard to understand is for convertible or not. Okay. Any questions for issue date? So issue date, we don't need to use with and without method. Later on, case one, what happened? Shareholders, preference shareholders decide to convert it into ordinary shares. Okay, so first case is conversion date. Conversion date, what does it mean? Preference shareholders decide want to become your boss, ordinary shareholders. Okay, so which method we use? Book value method. So please finish by yourself. I think you could finish it by yourself, right? Change preference shares become ordinary shares. So conversion date, what should we do? Preference shares and convertibles. Two things, remember, change two things, convert into ordinary shares. Okay? Then each one convert to 25 ordinary shares. Here I told you, each one convert to 25. So what does it mean? One preference shares become two. Become 25 ordinary shares. And in our case, how many total we have? 1,000, right? 1,000? Yeah, 1,000. 1,000. So will become 25,000. One preference shares converted into 25 ordinary shares. So 1,000 preference shares become 25,000 ordinary shares. Okay? So convert preference shares become ordinary shares using book value method, right? So book value methods means what? Means book values converted into ordinary shares. Okay? So preference shareholders become ordinary shareholders. So how about share capital? How much? Share capital. We have 25,000 shares, right? 25,000 shares. Each one par value $2. Okay? Preference shares become ordinary shares. Preference shares become ordinary shares. Okay, any questions? No problem. So that's case one, when preference shareholders decide to become your boss, ordinary shares. How about the case two? So what's the case two? They give us the right. So your company buy back the right. Okay. So repurchase date is the date your company buy back the right. Okay. So preference shareholders give us the right. Investors give us the right. Okay. If you remember, when we talk about CB, buy back the right, still we have to use with and without method, right? But remember, convertible preference shares is equity, equity, and equity. So we don't need to use with and without method to separate into two parts. We don't need to. Okay? So we don't need to use with and without method because they don't have the liability part. So we don't need to separate them into two parts. Okay? So for this, did you find out what's the book value for preference shares? Book value how much? 1,000 plus $199,000, right? So totally book value $2 million. How much money you spend? Here told you 2 million? 200, sorry, 200, right? Yeah, 200. So this is book value $200. How much money you spend? $410,000, right? So remember, it means what? That's your gain or loss. You spend more money to buy back the same rights, right? Before you sell it with $200. Right now, you buy back the right with $410,000. So you spend more money to buy back the right. How much money you spend more? The different, right? So spend $210,000 more to buy back the right. Okay, spend more money to buy back the right. So that's your loss, right? But remember, for equity, we don't use gain or loss. So which account we use? Okay, so which account we use? Share premium, right? So for equity, no gain, no loss, we use share premium to tell you is gain or loss. Okay, any questions? No problem. Okay, so right now we have the loss $210,000 to buy back your convertible preference shares. So which account, which journal entry we use? For preference shares, decrease. Why is that? Because we buy back your preference shares, right? How much money we spend? $410,000. So we use $410,000 to buy back convertible preference shares. Okay, so the difference is our gain or loss, right? How much? $210,000. So we have a loss is 410 minus 200,000. So I have a loss $210,000. So here maybe you will write down share premium dash conversion equity, right? So usually we should write down share premium dash conversion equity for the loss. Usually. So maybe you will write down here share premium dash conversion equity. But the problem is when we write down the account, we have to figure out the ending balance is normal or abnormal. So for this, if we don't have the number before, so for example, for this account, at the beginning we have $199,000 for your share premium dash conversion equity. But today, when we decide to repurchase it, it decreased, right? Repurchase. If we assume, if in this case, if we assume we don't have other numbers, we have only these two numbers, then today, what if I decrease, I debit $210,000? In the end, you will find out the balance $210,000. The amount, any balance appear on abnormal balance. What's an abnormal balance? Usually, last number should appear on normal balance. Okay? So, when you find out the number appear on abnormal balance, 异常余额 is quite hard to explain it. 正常余额 Okay? Because of this, we cannot accept the number appear on abnormal balance. Why? Abnormal balance means is abnormal. We cannot explain it. Okay? So that's why we don't use this account. We decide to use which account. If you remember for your first year when we talk about treasury shares, 库藏股, we use the same concept. When you find out this account don't have enough balance to use, then we will use which account to get the money? Retain earnings, right? Remember that? We talk about the same case for your treasury shares, 库藏股. When you find out you don't have enough money to pay, then usually who's your best friend? Retain earnings, because you can get all the money from retain earnings to pay everything. So that's why we use retain earnings. Means what? Means we decide to give preferential holders more money. We decide to share more profit with preferential holders. So that's why we pay more money to buy back the preference shares. Pay more cash to buy back preference shares. Okay, why? Because you want to share more profit with preference shareholders. Okay, retained earnings usually is the account we use it to share profit with shareholders. Okay, so today we decide give preference shareholders more money. Means what? You want to share more profit with preference shareholders. Give them more money, then buy back the shares. Okay, because we share the profit from retained earnings. So when we use retained earnings to pay the money to shareholders, means we share the profit with shareholders. So today we want to share more profit with preference shareholders. That's why we pay more money to buy back the right and buy back the shares. Okay, any questions? So there's total cases contents we have for convertibles 转换权. Next week we will talk about another case, another security. Okay. So that's it for today.